All right, let's get right into the third quarter earnings for Easterly Government Properties. That's ticker DEA. Now, you hear what they do, renting super important buildings to the U.S. government, and you think, wow, that's got to be stable, right? Well, yeah, but the market's reaction to their latest report tells a slightly different story. So we're going to unpack all of that for you.
So, how are we going to make sense of all this? Well, here's the game plan. First, we'll hit the scorecard for Q3, just the raw numbers. Then we'll dig into management's playbook, what they're telling investors. After that, we'll look at the market's reaction, because that's where the real story is. And finally, we'll give you our rating and what we're watching for on the next call. Okay, first up, the results. And, the main headline for Q3 is it was a really solid by-the-book quarter. Easterly pretty much hit all their marks, delivered exactly what the analysts were expecting. So on the surface, no drama, no red flags, just, steady as she goes.
And when you dig in, the precision is actually kind of interesting. Let's look at core funds from operations, or FFO. For anyone who doesn't live and breathe REITs, that's the metric that really matters for them. It's basically a much better gauge of their actual cash flow. And DIA, they hit 76 cents a share. I mean, bang on the consensus. And revenue, it actually beat by just a little bit. So on paper, this thing looks totally clean, a perfect quarter.
So that 76 cents per share, what does that translate to? We're talking $35.6 million in core FFO for the quarter. And you can really think of that number as the cash engine for the whole company. It's the money that pays the dividend. It's the money that funds their next big project. It's the lifeblood.
And the top line, the revenue story, just as strong, a 15% jump year over year. I mean, that's not small. It tells you their portfolio is growing, right? They're either buying new buildings or their existing leases have rent bumps kicking in. Either way, it's a really strong signal of momentum.
Now, let's talk about a really crucial number for stability. Their weighted average lease term is almost 9.5 years. Think about that for a second. That gives them incredible visibility into their future cash flow. I mean, their tenants are U.S. federal agencies. They are not packing up and leaving. That's about as secure as it gets. Okay, so the numbers were solid, right? Check. So what was the story from management on the earnings call? Well, they really hammered home their disciplined long-term growth strategy. And, the CEO, Daryl Crate, he really summed it up perfectly. He said, "Our tenants' missions endure across administrations and cycles." And that quote, that's their whole business model in a nutshell. The idea is that it doesn't matter who's president, it doesn't matter what the economy's doing. The FBI still needs an office. That durability is the foundation of the whole company. Okay, now this is where a really important theme popped up, especially in the Q&A session. A plan to deleverage. All that means is they want to pay down their debt. Right now, their debt is sitting at about 7 to 8 times their cash flow. Their goal? Get it down to 6x. So why does that matter? Well, it makes them look a lot more like their competitors, and more importantly, it should make it cheaper for them to borrow in the future. And how are they going to do it? By taking the cash from their big new development projects, like that huge FDA facility in Atlanta, and using it to pay down debt instead of just buying more stuff. And this is where the market's mood really started to change. So they tightened up their guidance for this year, 2025, which is normal. But they also gave their first look at 2026. And if you do the math, that new range points to a growth rate of maybe 2 to 3%, which is, it's fine, it's steady, but it's not exactly setting the world on fire, and it kind of signals that they might be tapping the brakes on buying new properties. So, how did investors react to all this? Well, it seems like they looked right past the perfectly fine Q3 numbers and zoomed in directly on that future guidance. And the market's verdict? It was swift, and it was pretty darn clear. The stock dropped over 3% on the day of the earnings call. But here's the key thing to look at, the volume. It was more than double the average. That tells you this wasn't just a few people selling. This was big money, big investors actively making a change and saying, okay, based on this new information, we're changing our minds. Yeah, this analysis really just hits the nail on the head. The stock didn't fall because of the quarter that just ended. It fell because investors were looking ahead to 2026 and saw what they believed was a slowdown in growth. And this, right here, this is the core of it. You basically had two competing narratives. On one side, you had management telling a story of stability, consistency, predictable cash flow. But on the other side, you have the market. And the market, especially right now with interest rates being what they are, was looking for a story about growth. And the story management told just didn't quite deliver on that front.
All right, let's pull all these threads together and figure out what this actually means for the stock from here on out. It's time for the next call, our rating.
So, this really is the big question, isn't it? After you digest the solid results, the, let's say, cautious guidance, and the market's negative reaction, what do you do? Is Easterly a buy, a sell, or a hold? Our rating is market perform. Here's what that means. We think the stock is probably going to trade pretty much in line with its competitors for a while. That super stable government-backed cash flow, that provides a really solid floor under the stock price. But that conservative growth outlook, that's probably going to act as a ceiling, capping the upside for the time being. So let's just boil this all down one last time. The bull case, it's super simple. You're basically buying a bond-like stream of income backed by the full faith and credit of the US government. Hard to argue with that. The bear case? With interest rates so high, it's just plain expensive for them to go out and buy new buildings to fuel growth. So what are we watching for next quarter? Number 1, progress on that huge FDA Atlanta project. Number 2, any news at all on the acquisition pipeline. And number 3, and this is the big one, are they making real, tangible progress on that plan to lower their debt? In the end, it really all comes down to one question. Is that rock-solid stability enough to make up for slower growth? That's what the market is trying to figure out right now. And remember, this is not financial advice.